Coming now to what I believe is the most important section in this reading, common ratios used in financial analysis. What we'll do first is identify the different categories. We can have activity ratios, which essentially measure how efficiently a company is performing. A classic example of an activity ratio is revenue divided by assets. This is also called the asset turnover ratio. This is showing that per unit of assets, how much revenue is a company generating. There are several other activity ratios which we will see on the next slide. Liquidity ratios we have seen before in the reading on the balance sheet. Solvency ratios were also discussed in the balance sheet reading. Profitability ratios we saw briefly in the income statement reading. They tell us about the profitability of a company. Examples would include net income over sales. And here we will also look at mixed ratios where the numerator comes from the income statement and the denominator comes from the balance sheet. Valuation ratios we will touch briefly in this reading, but we will see in a lot more detail later when we study equity and fixed income. Essentially here we are looking at the quantity of an asset or a flow on a per share basis. A classic example would be EPS, or we might also have ratios such as price to earnings ratios. In earlier readings, we generally focused on single statement ratios. So we had ratios from the income statement such as the gross profit margin, operating margin, or net profit margin. Then from the balance sheet, we had liquidity ratios and solvency ratios. And with the cash flow statement, we had ratios that took a numerator and a denominator from the cash flow statement. Now we will spend a lot of time on mixed ratios where the numerator comes from the income statement and the denominator from the balance sheet. The numerator could also come from the cash flow statement. As a general point, you need to be careful about how you interpret ratios. The interpretation should be in the context of the goals and strategy of the company that you are evaluating, industry norms and economic conditions. Let me elaborate. Consider two companies, Intel and AMD. They are in the same business. Both make chips, but they follow different strategies. Intel is a market leader. It tries to come up with new and innovative products, whereas AMD is a follower. AMD essentially tries to copy what Intel is doing. That is putting it very simplistically. Clearly, even though the two companies are in the same industry, but they follow different strategies, so chances are that their ratios will be different. Clearly, the R&D expenditure for Intel will be much more than the R&D expenditure for AMD, which might imply that overall the asset, assuming that R&D is eventually capitalized, the assets for Intel might be higher, relatively speaking. Without getting into the details, the point is that these different strategies impact ratios. So when we compare the two companies, we need to be aware that the goals and strategies are slightly different. Industry norms is a very important point. Clearly, a ratio is good or bad depending on how that ratio is relative to the standard in the industry. The current ratio in a given industry might be 1 on average, whereas in another industry, the current ratio might be 0.3. So when you are coming up with the ratio for a company, it needs to be looked at in the context of the industry. Economic conditions means that the ratio you come up with should be considered with respect to the current state of the economy. If the economy is in a recession, then in general, net income and operating income will be low. So profitability ratios are likely to be low. On the other hand, if the economy is booming, then the profitability ratios are likely to be high. Let's take a deeper look at activity ratios. Here are the activity ratios that you essentially need to learn. And over the next few slides, I will take you over these ratios and help you understand what they mean, help you interpret them, and help you remember them. Let's start with the first one, which is extremely important, the inventory turnover ratio. The formula is cost of goods sold divided by average inventory. And the interpretation of this ratio is that it tells us how many times per period was the entire inventory sold. This is a theoretical number, it's an approximation, but just to let you understand where this is coming from, think of it this way. Let's say that over a period, the COGS for a company was 200. And during the same period, on average, the inventory was equal to 10. The inventory turnover ratio then is 200 over 10, which is 20. So what is the interpretation of 20? This is approximately the number of times per period, so this period, that the entire inventory was sold. Now, a few more remarks about this ratio. Notice that the income statement item is in the numerator and the balance sheet item is in the denominator. We also use average inventory. The point is that if at the end of the year it just turns out that the inventory number is very high because the company is building up for the next year, but in general during the year the inventory was maintained at 10, then clearly it makes sense to use 10 as your denominator and not 25. As a financial analyst, however, you might not know the exact average inventory. So what you would normally do is use the average of the beginning period inventory, which you can get through the financial statements, and the ending period inventory. The principle though is that you should ideally use the average. If you don't have those numbers, you just have the end of period number, then that's what you use, hoping that the end of period number is indicative of the average inventory during the year. If you have access to quarterly reports and you have inventory numbers for the end of every quarter, that is very good because then you can get a more accurate average inventory number by using all the end of quarter numbers. This should be obvious, but I will state it anyway. A higher number for the inventory turnover ratio shows greater efficiency. If you have another company that manages to have a lower inventory balance with the same cost of goods sold, that means it is managing its inventory better and it might have a higher turnover ratio such as 25. You also need to understand this item, days of inventory on hand. This is calculated by taking the number of days in a period. So if we are taking a 1 year period, then we have 365 days in a period divided by the inventory turnover ratio. In our simple example, if we have 365 divided by 20, then the days of inventory on hand is 18.25. This is a measure of, on average, how many days of inventory do we maintain. Obviously, if the activity ratio is higher, then that means that on average we maintain a lower amount of inventory. Receivables turnover ratio. This is the revenue divided by average receivables, and this measures how quickly a company collects cash. Generally, it would be more appropriate to use credit sales divided by average receivables rather than revenue, but often credit sales numbers are not available. Therefore, analysts tend to use the revenue number. A higher number for this ratio shows greater efficiency. We also need to calculate the days of sales outstanding. This again is the number of days in a period. If we are considering a year, then we have 365 days divided by the receivables turnover ratio. If this number is large, that means that it takes us a long time to collect our receivables. Payables turnover ratio. This is purchases divided by average trade payables, and the interpretation is the number of times per year that a company pays its supplier. As an analyst, you might not have access to the purchases account. Then what you use is the cost of goods sold plus change in inventory. If you have a given period where COGS is equal to 200, the inventory at the start of the year was 10 and at the end of the year is 30, then this means that the purchases must have been 200 plus the change, which is 20. So purchases must have been 220. So that is the precise measure to use. At times, an analyst might simply use purchases as approximately equal to COGS. In terms of interpreting the numbers, a relatively high number for the payables turnover ratio would mean that a company is not making good use of credit facilities. A very low ratio might indicate possible liquidity problems. The working capital turnover ratio is revenue divided by average working capital. This tells us how efficiently a company generates revenue from its working capital. And just to remind you, working capital is equal to your current assets minus current liabilities. At times, if the current assets and current liabilities are roughly the same, then this number would be approximately 0 and the ratio would be meaningless. We can also look at the fixed assets turnover ratio and the total assets turnover ratio. The total asset turnover ratio is revenue divided by average total assets, and this tells us how efficiently a company generates revenue from total assets. We have looked at several ratios, and you might be wondering how you can remember them. I'll give you a very simple technique that will make it easy for you. The first point is that the name tells you the balance sheet item. Notice that in all these ratios, you have an income statement item in the numerator and the balance sheet item in the denominator. With the receivables turnover ratio, we have average receivables over here. With the total asset turnover ratio, we have total assets over here. So clearly, you know the balance sheet item based on the name. From the balance sheet item, you can determine the relevant income statement item. If we have assets in the denominator, the relevant item in the numerator is revenue. If we have inventory as your balance sheet item, then the relevant item would be cost of goods sold. So based on the balance sheet item, you can figure out the relevant income statement item. As I've already mentioned, the income statement item is going to be in the numerator for our activity ratios. And then also notice that in general with the balance sheet item, we use an average value. If you can remember these 4 points, then that will allow you to remember all the activity ratios.